Today, we're not just talking about buying a house. We're cracking open the investor's blueprint. We're going to dig into the real mechanics of how wealth is actually built, piece by piece, with property. Let's get into it. So, how does this all really work? Most people think it's as simple as buy low, sell high. But if that's all there was to it, well, wouldn't everyone be a millionaire? The truth is, building serious wealth in real estate is a much richer, more interesting strategy than just waiting for the market to go up.
First things first, before we can build anything, we have to understand the ground we're building on. You see, real estate isn't like stocks or crypto. It plays by a completely different set of rules. Getting your head around this unique terrain, that's step one for any serious investor.
Let's start with the obvious physical stuff. Real estate is tangible. You can literally walk up and touch your investment. It's also immobile, which is why you hear that old saying, location, 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 over and over again. You can't just pick it up and move it to a hotter market. Plus, every single property is unique. And, maybe most importantly, they aren't making any more land. That fundamental scarcity is a huge part of its long-term value.
Now let's talk about its financial personality. For one, it's illiquid. You can't just sell a building with the click of a mouse like you can a stock. But the upside? It can be a fantastic hedge against inflation, protecting your money's value over time. And it often does its own thing when the stock market is going crazy, which gives your whole portfolio some much-needed balance.
Okay, so we get the asset. Now it's time for a big decision. Every single investor has to choose their path. Are you going to be the one in the driver's seat, hands-on, or are you going to be a passenger? This choice pretty much defines your whole journey from here on out.
You've basically got two roads you can go down. The first is the direct or active path. This is you buying the property, finding the tenants, fixing the leaks, you're making all the calls. The reward? You have total control and the potential for much higher returns. But it takes a ton of your time and a lot of cash to get started. The other road is the indirect or passive route. Here, you're putting your money into something like a real estate fund and letting the pros handle everything. It's way less work and easier to get into, but you give up that control and some of that top-end return. There's no right answer here, just what's right for you. And now we get to the really good stuff. We're about to pop the hood and look at what I call the 4 wealth engines. These are the 4 powerful, distinct forces that work together to really drive your returns. This is the core of the whole blueprint. And here they are. You've got income, appreciation, leverage, and those amazing tax benefits. I'm telling you, trying to build wealth without all 4 of these is like trying to drive a car with 3 wheels. You're just not going to get very far. Let's break them down.
Engine number 1 is income. Simple, right? But it's so powerful. This is the cash flow, the rent checks that hit your account month after month. It's the lifeblood of an investment property, giving you that steady, predictable return you can count on.
So, how do the pros figure out a property's income potential in like 5 seconds? They use one key number, the capitalization rate, or cap rate for short. It's basically a simple formula that tells you the property's annual return just from its income. Think of it like a quick pulse check on the financial health of a building.
All right, let's fire up the second engine, appreciation. Now, this is the one everybody knows and loves. It's the classic idea that the property you buy today will be worth more in the future. It's the buy low, sell high part of the wealth equation.
But here's the thing. Appreciation isn't just magic or luck. It's fueled by massive, real-world forces. We're talking about things like a growing economy, new train lines being built, more people moving into a city. All these things create demand, and when you combine that with the fact that there's a limited amount of land, well, prices tend to go up.
Okay, I need you to lean in for this one. Engine number 3 is an absolute game changer. We're talking about leverage. And in plain English, it just means using other people's money, usually a bank's, to control a much bigger asset than you could afford on your own.
Let's just run some quick numbers. Say you buy a 15 million peso property. You pay all cash. A little while later, its value goes up, and you've made a 3 million peso gain. Your return on that investment is 20%. Not bad at all, right? A solid return.
But what happens if you don't use all your own cash? What happens when you bring the bank into the picture and put the power of leverage to work?
And here it is. This is the magic. Same property, same 3 million peso gain. But this time, you only put down 3 million of your own money. The bank loaned you the rest. That 3 million gain is now measured against your initial cash. Your return isn't 20% anymore. It's 100%. You just doubled your money. That's the incredible power of leverage.
Now hold on.
We have to have a serious moment here, because leverage is a double-edged sword. It's an amplifier. It makes the good times great, but it can make the bad times absolutely devastating. If that property value goes down instead of up, your losses are magnified too. So managing that risk is everything.
And that brings us to the fourth and final engine, tax benefits. This is the secret weapon that smart investors use to boost what they actually get to keep. Things like deductions for expenses and depreciation can seriously improve your net returns. It's not just what you make, it's what you keep after taxes.
So we have our 4 engines: income, appreciation, leverage, and tax benefits. The big question is, how do the pros actually put all these pieces together? Let's take a look at how these engines power real-world strategies. You see, pros don't just buy buildings, they execute a specific strategy. A core strategy is low risk. It's all about that steady income engine, like owning a fully leased office building. Value add is a bit riskier. That's when you buy an older building and renovate it to boost both income and appreciation. And then you've got opportunistic. This is the high-risk, high-reward stuff, like building a whole new development from scratch, hoping for a massive payday.
And this all boils down to one last critical idea: beta versus alpha. Think of beta as just riding the wave. The whole market goes up, and so does your property. You get a return just for being there. But alpha? That's different. Alpha is the extra return you generate because of your own skill and hard work. It's not about riding the wave, it's about building a faster boat.
And this is so important. Any passive investor can get the market's beta return. But the true professionals, the ones building incredible wealth, they are obsessed with creating alpha. They use their expertise to make a property worth more than the market says it should be.
So we come full circle. Real wealth in real estate doesn't just come from one thing. It's the powerful interaction of all these different drivers: the cash from income, the growth from appreciation, the incredible boost from leverage, and the savings from tax benefits, all guided by a smart strategy. So we've laid it all out for you, the entire blueprint. You've seen the unique landscape, the different paths you can take, and the 4 engines that drive it all. So the only question left is for you. Now that you have the plan, what kind of wealth are you going to build?